My name's Andy Hirsch. I'm a partner at Wilson Sonsini, and I'd like to welcome everybody to tutorial number 37 of the Wharton Entrepreneur Series. We're going to talk about venture debt and overlooked sources of capital in the startup ecosystem. Usually this introduction gets done by my partner Doug Collum or Herb Faulkner, and neither one could be here today, so they decided I was doing the introducing, even though I'm probably the only one here who's never been to it before, but welcome. As I said, I'm a partner at Wilson Sonsini. I've worked in the venture debt area since about 1990. The first person that I worked with in this area was Jim Mitchell, who's one of the founders of Meier Mitchell Company, which was one of the early venture lenders. And Jim, you want to talk about your background? You have your Wharton connections and everything, so.
Yeah, I am a Wharton grad from Philadelphia, 1975, prehistory. And I graduated from Wharton, came to San Francisco, worked in finance. I was a corporate finance major at Wharton, doing large ticket, credit-worthy leveraged leases around the United States. And the fun thing about being in San Francisco is it's a few miles north of Silicon Valley, and in the early 80s, we saw this bubble of activity down in Silicon Valley, and it was manufacturing for semiconductors and disk drives and electronics, and it was a fairly exciting time. Hambrick and Quist was dominating the investment banking world at that time, taking people like Genentech public and Sun Microsystems. So it was a really interesting place to be. The most interesting thing to us being finance people was that other than equity, there was no other financing available to the startup companies. So another fellow and I, Lee Meier, started Meier Mitchell Company, designed expressly to provide debt financing to venture capital-backed companies, at least initially in the Silicon Valley, ultimately in the United States, Canada, and Western Europe.
What year was that?
We started the business in 1984. And I think it was 1989, we began working with we had a couple of institutional partners, and a large finance company, GATX Capital, began working with us as our funding source, our other general partner, in 1989. And they mandated that we have superior legal documentation. And that's when they introduced us to Andy, who at the time was over at Orrick Harrington, and then our
and I was a second-year attorney, so I'm not sure about the superior legal.
Well, we had to at least pay a lawyer and not do it on the back of an envelope. So we followed our business followed Andy as he went down to Wilson Sonsini. And I guess the reason the two of us are sitting here is that between us, we more or less started and developed and evolved the venture leasing business, which is now the venture lending business. So anyway, that's my background and a little extra.
So we're going to, I guess there's the first slide, we're going to talk about just the different types of loans, and we're going to try and go through and set up what we're talking about here. And it might be helpful if folks could give us an idea of who the audience is, so that we know who we're talking to. I know there's at least one lender here, but how many people are on sort of company side entrepreneurs? And equity investors, and then lenders. Wow, that's a lot. All right. So, so good mixed audience, and so hopefully people will jump in. So we're going to set it up just talking about the types of financings. First two that we have on the list up there are venture loans and growth capital. Jim and I were arguing the other day about what they're called. People call them all sorts of different things. Venture loans being more early stage, growth capital being, as you might think, later stage. But I'm perfectly guilty of using them completely interchangeably. So other types of loans that are available to startup companies include accounts receivable financing and equipment financing.
The business actually started as equipment financing. The idea was to finance manufacturing equipment, which was actually collateral, meaning that it had a value. If the company failed, you could liquidate the collateral and get a portion of your investment back. So My background being leasing, equipment leasing, the business started as leasing, but as manufacturing moved offshore, we either could go out of business or morph our product to address more than just leasing. So it evolved ultimately over time to, as we used to phrase it, we were financing air. We were financing just the enterprise value of the startup emerging growth company. But there still, if you're a startup company today, there's still vendor leasing programs, so maybe you can get your computers leased to you. You certainly lease your office space. There's other assets you might need that you could have leased to you. But in terms of going to a bank or a finance company, a venture lending company, and getting a venture loan, that would be basically a debt line of credit that you could draw down on over time. And that's the product that we're going to talk about today. But for startup companies, generally they don't have receivables. So if you were a young company and you had receivables, you could probably get receivables financing. You get those through a bank, and generally the venture lenders aren't so interested in financing receivables.
Right. But a lot of times there's a combination of those, especially if you're doing a transaction with one of the banks. It's often a term loan and then a small accounts receivable that fits whatever receivables are in the company at that point. So you get both pieces. Jim was talking about financing air. I remember when you were starting to do those really early loans, and I couldn't get it because there was no collateral there, and I said, well, so really this is an unsecured loan, and Jim says, shh. He had explained this to GATX, which was the big finance company.
That's right. Yeah, that was a tough sale. They did not understand that. So why don't we talk about what a venture loan is. Venture loan is really, it's a loan. You probably all know what loans are, but the most interesting thing about a venture loan is it's made to a borrower who really, for the most part, doesn't have any visible means of repaying the loan. And that's the magic of the product and why it's worth talking about. Startup companies generally don't have the traditional credit indicia. They don't have a quick ratio. They don't have certain profit ratios. They don't have EPS. There's a lot of things they don't have. A lot of our borrowers have no revenues. So how do you assess that particular credit? How do you provide them financing? Well, that's the venture loan. We'll talk about the other components. But simply stated, there's components of the loan, how large a dollar amount, and in today's market, those get quite large, but nonetheless, it's how much do you need and how much can the value of your enterprise support, how much promise do you have, what's the maturity of the loan. These loans tend to be fairly short, 3 to 5 years. How are you going to structure the repayment of the loan? If you're a borrower, you'd like to repay it maybe with a lump sum 20 years from now, but the lender is not too sure you're going to be around, so they strike a compromise somewhere with how to structure the debt repayment stream. So you might have an interest-only period which has relatively low payments, followed by an amortization period for a total term that's going to push out to somewhere between 3 and at the most perhaps 5 years. And then there's the warrant coverage, which is the equity kicker that the lender likes to get for being in the venture lending market, hence the word venture, meaning premium returns, hopefully, associated with taking a lot of risk. So we'll talk about the warrant structure and the terms and all of that when we get a little further into the presentation.
In fact, we can just go, what we did was we took that list that Jim just went through and just threw out some numbers there, so sort of a typical midstream loan. This is not, this is $10 million. It's not an early stage, but these are some examples we can use and refer to. There's a big difference in the market between smaller loans and later loans. We were just talking to Mike Meier from Silicon Valley Bank, and it used to be when I started and until the recent years that unless it was really small, many of these loans were $2 to $5 million, and that area is dominated by the banks now. The non-bank lenders don't lend much into it. So if you look at the example here of $10 million loan, maturity in 42 months. Jim talked about interest only versus amortizing. A lot of times there's an interest only period. For example, we've got up there 12 months interest only, and and then 30 months amortizing. There's lenders out there that will just do it in a bullet now, where there's products that are often subordinated, and they'll go for 48 months and payable completely at the end. That's usually much later stage companies where the assumption is that there's probably a sale exit strategy very often. Talk about interest rate, Jim. You want to talk about how to put that all together? There's a lot of pieces to it, and people often think about it all broken up. And I mean, one of the messages is that you should think of it all together.
Yeah, you definitely should think of it all together. The all-in pricing on these things, the aggregate interest rate, is something that evolved over time. What the lender was sort of interested in disguising the total interest cost of the loan transaction. And this is, I'm being totally honest, we used to go in and ask for a 13 or 14% interest rate, and we just got a gag reflex that was usury. We're just not going to pay that. I don't care how much money you're willing to give us. We don't need the money that bad. Of course, they'd raise equity, which has an enormous cost if you ever slapped an interest rate on it and you were successful. So we actually broke up the interest rate component into multiple pieces. We'd do an upfront fee, and then we'd have a stream rate, which would be the interest rate that amortizes the loan amount. And then we put a balloon payment on the back of the term, which was very advantageous for the borrower because it pushed his cash flow obligations farther out in time, which time he was likely to be highly successful, a public company, and rolling in the dough. So anyway, in order to get the mid-teens rate of return that the lender needed to make the business model work, we ended up breaking it into multiple components. So in this prototypical transaction that Andy's generated for us, we've got half a percent upfront fee. It's not, at least it didn't used to be uncommon to charge more than that. And then a running rate, and then a final payment of 3%.
And I put up 10% there as the rate, and really I should have put a single digit because everybody likes the single digit there. Talking about disguising it all. So.
Yeah, exactly. So there's actually some optics involved. I mean, it's the reason something cost $1.99 instead of $2. It's just human nature. We used to offend the venture partners with our high rate, and I always found that pretty amusing. They have no shame.
Right. So anyhow, then we just talk about the warrant coverage, which I've thrown up there as 7% of the loan amount. That varies. If we're talking about smaller loans, it's much more likely to be in 1 to 5%, under $5 million. For the bank lenders and the non-bank lenders, it's could be anywhere from 5 to 12%. It just depends on the what the company is, who the lender is, et cetera. Typically, venture loans don't have any financial covenants. If you have a loan with a accounts receivable facility, sometimes there is a covenant, but prototypically there isn't. Then covenants, people will put out term sheets. They'll say covenants, none. Not really true. There's affirmative and negative covenants that you have to deliver financials, and you're not allowed to incur debt, liens, do M&A activity. Those are all limited, so that's always out there. Default provisions, standard things like not paying back at default. People talk about are material adverse change events of default. A few years back, I think it was one of the banks, it probably was Silicon Valley Bank, came up with the investor abandonment default, which is sort of a material adverse effect light, where the banks and the lenders figured out, if you're a bank, almost anything can be fixed by investors putting in more money, right? And it doesn't fix the company, but if you're a lender, it pays you back. So basically, it's a default at the point where the lenders walk away completely. So so there's those types of variations. Change of control, is also a default. If you're getting sold, usually these get paid off, so that's not a big deal. But talk about warrant terms.
Yeah, the warrant is a very important component. That's the equity kicker for the lender. So the the lenders has discovered over time that the length of the warrant is very important to him. We had numerous warrants that expired at the end of 10 years with companies that were still in business. It expired underwater. So the warrant term, the lender is going to want as long a term as possible, and to tidy up the bookkeeping and the equity accounts of the company, the borrower is going to want really as short of a warrant term as possible. So it's not uncommon to have a 10-year term, or often they'll have a stated term. Andy's example here is a 5-year term, but it'll be the shorter of 5 years or 1 year after the IPO. What we find is that the investment bankers, the underwriters, like to clean up the equity accounts of the company, so they don't like the overhang of warrants. So they like to get the venture lenders to exercise those warrants, get them off the books, so they'll have an expiration that will be tied to the IPO date. And so
but the venture lenders don't like to have the expiration.
No, it's a negotiation.
Right.
The warrant document is a highly evolved document. Both the issuer and the lenders have discovered over time that certain problems were created by the existence of these warrants and the exercise of these warrants. So the document is, as I say, it's highly evolved, and the borrowers, the lenders are going to negotiate the provisions that protect them with vigor, because they've had some pretty negative experiences over time of real value being lost because of provisions in the warrant.
Yeah, in fact, there's, with warrants that are given to venture capitalists, often they're much lighter in terms of the amount of documentation and so on, and the covenants in them. And that's largely because the VCs can protect themselves on the board, and the lenders are not at the board table, and so may get forgotten. So they protect themselves contractually a lot more.
Indeed. So that will be negotiated heavily, but typically the exercise price isn't as negotiated, because in most situations the exercise price of the warrant will be equal to the last round of equity that was raised. It's quite common to do a venture loan right on the heels of an equity fundraising. So the valuation of the company will have been set by the investment community, by the venture capitalists, and the lender will just inherit, if you will, or take that pricing, that valuation, and incorporate it into the warrant. If there hasn't been a valuation event anywhere nearby when the loan is being executed, then they may have a formula to do it at a discount to the next round or a premium over the last round. But I find it's pretty rare that the venture lender will engage in a valuation negotiation with the borrower, just to create a new valuation different from what the venture investors have done previously.
I mean, one of the interesting things that's happened in the last 5 or so years is that one thing we didn't mention is that typically these transactions have been done almost exclusively with companies backed by recognized venture capital firms. And so there were professional investors doing a valuation, and so you typically had a strike price on these warrants that was pretty much what fair market value was, and so there's a lot more lending to companies that haven't done an outside round yet, or have done only an angel round, and so on, and so there's a lot more, and we'll talk about this a little more later, negotiation about what's the right exercise price on these warrants when there hasn't really been an outside valuation. All right, so we're going to talk about a lot of these things in more depth as we get into this, and feel free to yell out if you want to talk about any particular point in detail. So just talk about venture loan security. Typically these loans have, as Jim said, when this started out, it was just equipment leasing, and so it was just the equipment securing the deals, and then they morphed into an all asset lien. Over time, it became very typical to have all assets except the intellectual property. And that is just a function of the fact that people in the Valley really are worried about their intellectual property, not surprisingly, since that's most of the value. But this goes to another thing is, like, if you're a lender and you want collateral that has some value, why would you give up the IP? It just the market. I mean, it doesn't make any sense if you're a lender. But a lot of times what people do is they say, well, look, it's unlikely that this company is going to have huge other debts. We're not going to let them borrow other money and so on. And a lot of companies don't have a lot of trade debt and so on. So, when it comes down to it, the outcomes are a little binary. And if they're going to crash and go under completely, well, we might not get paid. If they don't, if it's sideways, if there's an exit, we're probably still we're gonna get out that way. So there's just other ways to protect yourself than strictly the lien.
I will say, though, that when companies begin to fail, they do accumulate all sorts of debt, trade debt. They're in arrears on their real estate lease. It's amazing the amount of obligations that they're able to generate as they're declining and they see a real significant brick wall in front of them. So when things start to unwind, all the normal assumptions tend to unwind.
Right.
We had one, I'll just tell this little anecdote. We had one company, we were able, it was a security software company, and we were able to get a lien on the intellectual property. And this was a very idiosyncratic company because it was built around a founder who was a mad genius and had no business acumen whatsoever and had no social skills whatsoever either and was just impossible to deal with. Well, what happened was that Microsoft came in and wanted to buy the company for $50 million, which is a big number back in the day. And everybody was pretty excited about that. And the founder said, no, we're not doing that. We're worth tons more than that. So, fast forward 2 years later, the company's now in the tank. It's going south, but we're highly comfortable that our significant loan to this company is going to be just fine because we've got a lien on the IP. Well, it turns out that nobody wants to buy the IP because the IP in this particular case absolutely needs the mad genius founder to have value. And he alienates everybody that comes in to talk to him. So we had a great security interest. It was well filed, perfectly lawyered, and it still blew up in our face. So it's like you try your best, but sometimes it doesn't work.
Was that a venture capital-backed company?
Yes, it was.
And the investors were unable to do anything?
The investors were phenomenally uncooperative in assisting us, so they shall go unnamed. But they'd been working with this company and watched it go downhill for a year or so, and they just couldn't get any orders. Nothing could happen. And the VC, the partner had too many deals. He just sort of moved on down the road mentally. And man, we called him and asked for help. Yeah, you'll be all right.
Right.
And that was about all we got. Yeah. And he was wrong.
Yeah, I mean that's one of the things we'll talk about a little later too. Is that the credits in these deals is really the identity of the investors a lot of times. And
yes.
Go ahead.
No.
Do you have an assumed failure rate? Your position in the company obviously gives you a lot of security, but that's a circumstance where there's nothing you could do. Right at the end of the day, there's no value to be had. Do you have an assumed failure rate going into this from a portfolio, and then approach it from a portfolio perspective?
Yes, absolutely. We build a business model and we make projections of how a portfolio should perform based on historical and performance and projections for the future. And we used to run and build the model so that we could withstand 5% losses. We used to do all sorts of Monte Carlo simulations and find out that, well, if there were 10 or 12% losses in the portfolio, we would still actually have a positive rate of return if the rest of we got warrants as we expected and that sort of thing. The actual experience, the loss rate, I mean, I guess it really varied over time, but you could look at 3% as a representative number.
But it's pretty changed a lot over time because
yes.
Up through the through the 2000 through the internet bubble bursting, very few losses. The VCs actually would come in and they would try and take care of the venture lenders because they thought that was good business.
Yes, it was like a really intimate club. So they would do, excuse me, everything they could to keep a company viable or to minimally, as they dissolved the company, have them pay back the loan. We even had some VC reach into their own jeans and pay back the loan. It was amazing. And then the internet bubble burst and all sense of pride and decorum just went out the door and just, there was blood on the walls. Right. And they just let the companies go right and left because they couldn't afford to be gentlemanly about it anymore.
And that's pretty much how it is now these days.
It changed forever.
It changed.
That was an inflection point. Prior to that point, the default rate was astonishingly low, 1% or less. And then after that, it's changed.
Just following on to that question, what is the effective return for the industry, for the venture lending industry, would you say, over, kind of a median over time?
Well, for the industry, I'm not sure. Our experience was that we averaged between 17 and 20% long. Well, the venture capital industry and the study that was done, unfortunately, this is dated, was across the entire venture capital industry was something like 17%. And our rates were higher than that. Obviously, if you take a Sequoia or a Kleiner Perkins, they wouldn't sign up to 17%. But that was an industry figure. And where it is today, I am not sure.
Well, for the last decade, and there's probably folks in this room that may know this more than I do, the last decade it's been a lot lower than that. And
Particularly for venture lending as opposed to...
Yeah, that's what we're talking about. It's been a lot lower, and you can see that because the non-bank venture lenders have been having a lot of trouble raising funds. And some of them are going out of business, and so I think it's an indication that it's a asset class that's had a lot of difficulty. And I don't know, Mike, do you know what the whole industry is?
Actually high teens.
Yeah.
But to the point on the bank side, I mean, it's sort of mid-single digits for sort of revolving lines, and then as you get a little bit more aggressive, it's sort of high single digits. But the special debt funds are still having to get more and more aggressive, larger in size, but they're still going to be in the high teens. But that's including the warrant piece.
But since they're more and more aggressive, we'll see in 5 years or so
how intelligent that was.
Come out, yeah. So.
Yeah, I think the market's sort of bifurcated. There are firms that are having a lot of difficulty, and other firms continue to prosper. And those that are prospering, I'm sure, are achieving in the upper teens.
Do you have any rough approximation of the high teens? How much is interest and how much is warrants?
The running rates are, I'll probably have to defer to you on that one, but in the low teens. So the warrant matters to get them from 10, 12% money over money up to the mid to upper teens in terms of all-in return. And as you can expect, that's as with the venture capital distribution, it's just a few deals that make that difference. If you're, I guess Western Technology Investors was an investor in Facebook. Well, that helped.
And Google.
And Google, yes. So.
How fungible are the warrants? Can you trade them with any other venture debt entity, or is that purely held by the venture debt?
Typically not fungible.
Yeah.
They're generally, I can't remember if there's a provision that makes them non-transferable.
They're transferable usually, but the securities laws don't let you do it very easily. So people tend not to. But.
Yeah. So there was really no secondary market for them. I mean, oftentimes at the end of the day, we would sell them to an investment banker who would purchase them and do what they would with them. But for us, that was our exit. And so that by selling the warrant, we had a capital gain. We sold the asset.
That was after companies were public.
Yes.
Right.
Oh, yes.
Yeah.
I'm sorry. Yes,
Right.
definitely.
Right.
There was a market for the stock. It was not a
Right.
pre-public speculative investment.
Right. I mean, it's possible that with very hot pre-public companies where there's a secondary private market that I don't think I've heard much about people doing that in this industry. They tend to hold, but it's possible there's a little bit of trading in those situations, especially when you have some big investor coming in and buying secondary shares from insiders. It's possible they're getting invited in at the same time.
That does happen. We do.
Yeah.
But on very few occasions, and it actually sort of doesn't seem like the smartest move because you're selling probably to a VC that's looking at least at a 3 to 5x return on a pretty short horizon. So
Right.
it sort of
So a lot of times you're probably like selling a little piece of it or something, or just getting out. Yeah.
Because it's a locked-in return at that point.
Right.
Still probably not.
Yeah.
Go to our next slide to talk about some of. So this slide is about the basically the pitch Jim would give when he was talking to companies about why they should do this, or talking to investors about why it makes sense.
Yeah, originally, believe it or not, it was very difficult to convince startup companies that they should borrow money. They had access to equity, and borrowing entailed obligations and uncertain ability to meet those obligations. So it was a rational response that they'd be rather tepid about taking on debt. But the pitch that we made to them is that, look, this is really cheap capital. If the only other source of capital you have is venture capital equity, that's highly dilutive to the founders. So why don't you complement that equity and take maybe less of it by supplementing it with a debt package? And we'll give you a 3 or a 4-year loan. The idea is that over time, your valuation will increase significantly. You'll raise equity at a much higher valuation in the future. You'll use that equity in part to repay the loan to us, the lender. And if you pencil that out, you reduce the dilution that you suffer from how much equity you have to issue. So ultimately, it was a compelling argument. And interestingly, not just the founders, but the VC really put the sharp pencil to it and understood that for their position, it really enhanced their position. They could grow a company and get it out the door and create a real upside liquidity event for less of their capital. So their return was leveraged. I mean, it was ultimately, it was a really good deal. There's some downsides to debt, but the upside is that it really reduces dilution, and it leverages the return of everybody invested, other than the lender, everybody invested in the company. It also just obviously extends the cash runway. If you borrow money, you pay it back over time, and in the meantime, you've got additional cash to invest, and your survival rate is longer. So you can spread out the distance between, or the time distance between your last equity round and your next equity round. Hopefully during that time period, you'll create more value and get a better valuation in your next financing round.
Especially if you have the interest-only period.
Yes, yeah, right, indeed. One of the other interesting merits, and you don't really sell this one too hard, but the CFO or the CEO of the company might recognize it immediately as a benefit. There's a lot of points in time where the investor group behind a company is in disarray. They may not have, and so that's a good time to do a venture loan to extend your cash runway to allow the investor group to get back into sync as to what they would like to do with this particular company. So we've found that the board politics, the board being the VC, sometimes is a problem. It could be that one partner is leaving the firm and the other partners don't want to continue with this company, or it just could be that 2 VC firms have very different views on the strategic alternatives in front of a company, and so they can't get together on a valuation, they can't do a round. Venture debt is a good solution to some of those situations.
How do you distinguish those situations from the ones where it's just so dysfunctional that it's never going to get the next round together?
Well, I guess that's where the experience of a venture lender comes in. I mean, you just have to read the tea leaves and talk to a lot of the venture partners and see if you can figure out what's really going on. I mean, they generally don't like to share that sort of dirty laundry with you. So you just have to
but management
work
will
it.
Often.
Sometimes, yeah, actually they'll complain, the board's a mess. I think you can look at really, the things that are completely dysfunctional usually involves a company that itself is dysfunctional, is not achieving its business plan, has missed its milestones, whatever they are, and so there's something seriously amiss. And that is probably a company that you wouldn't approve for the financing in the first place. So I think you can sniff those out. Mm-hmm. Well,
or even increase the borrowing.
Well, it's well, there's two questions there. Definitely they come and they ask to increase the borrowing, do a follow-on borrowing, and just maintain the same documentation. It's the low-friction way to raise additional debt. That definitely happens, and that's usually pretty welcome. The other format usually in which they come to you is where they're having some financial difficulty, so they want to restructure the loan and buy some more time before they have to pay it back, defer payments or something of that nature. And that definitely happens. And there's a very constructive dialogue within the community between the venture investors, the company, and the borrower that usually takes place. It's very much in the lender's interest to work out something that causes the company not to hit a brick wall. Hitting brick walls is very bad for the lenders and the borrowers. So my experience is there's usually a lot of very constructive dialogue, and restructures do happen with some frequency.
There's also a phenomenon now is that there are long interest-only periods and so on, and there's a class of companies, especially at later stage, where they're getting growth capital loans, and often the negotiation is the extension of the interest-only period, which they like very much. They also, companies like to get to the end of the interest-only period and then try and refinance with a different venture lender to get another interest-only period. So that's another phenomenon that comes up a lot.
So Andy, since you represent the companies a great deal, maybe you would talk about why a borrower might be wary of entering into a loan.
Yeah, I mean, the things people worry about are, the ability to pay this back in the long term, and it kind of depends on the stage the company's in. With very early stage companies, the idea is that it's going to get paid back. If you do it right after an A round, it's going to get paid back, in part with a B round, and so that's where that's likely to come from. One phenomenon that this brings up is sort of the mid-stage company, where most lenders want to lend to very early stage because there's likely to be future rounds, and then there's lenders that want to lend at late-stage companies where the amount of they're going to get to cash flow break even before too long. In the middle, it's an area where it's difficult, right? Because you're often you're past technology risks, but you're trying to monetize and actually sell a product of some sort, and that's the point where it's easy to have a miss. And if you're dependent on the next round for repayment, that's something you just have to think about whether that's the right thing to do. And it's the same analysis that the venture lenders make too, is that they're much less likely to lend in that situation too, because that risk is harder to deal with than the other risks.
Mm-hmm. Yeah, one that I would also point out would be sort of the debt overhang, where you have so much debt and so much debt service in your immediate future that the venture capitalists will come and look at that and say, you know what, if we finance this company, we're just financing repayment of debt that was done for the benefit of somebody else. So that can actually deter new investors from entering into making an equity investment. So you've got to use the venture loan product with discretion.
Having said that, how often do you find that is an issue where you're sort of looking, you were looking to the B round as part of your security, and in fact, the B round investors say, no, we're not going to use that for repaying debt. We just want financial future growth.
If it's the same investor group that approved at the board level the first venture loan, we find that we don't have that problem. That's an unusual problem to encounter. It's usually when you get a new set of investors coming in, you're expanding the investor group. Some people looking to come in are going to say, we're not going to use our equity to repay that. The other time that you see it a lot is when a company is in distress. It's missed its milestones or this or that, and then you're going to have a down round. Those VC are going to be pretty merciless about using their money to repay debt as opposed to build the value of the company.
It can be the same issue with a M&A type exit too. It's where you have a big hunk of debt in there. It can be a real deterrent for someone coming in for a company that's gone a little bit sideways. So,
how close do you stay on the company as it develops? How active is your monitoring? And can you have the right to sit in board meetings?
Generally, the lender does not take board observer rights. They definitely don't take board seats. We monitor the companies closely. We usually, and contractually are allowed to receive the monthly or quarterly financials as they prepare them. And we usually would talk to the CFO minimally once a quarter, oftentimes more often. So I would say close monitoring, very close.
yeah. And with the later stage deals that get done these days, sometimes you'll see board observer rights on them too. And there's some, some venture lenders. I mean, it's interesting. It depends on somewhat on the background of the particular venture lenders. Some of them have come very much from an equity background and less from a lender background, and they're the ones that think they add value in a meeting, so they like to get board observer rights.
Yeah.
So we're talking about credit analysis and venture lending. We actually talked about this a little bit before, about the evolution of the underlying credit. Jim talked about that a little bit, so maybe we'll skip on and just talk about.
I'll make
about that.
Yeah, I'll just make one note here. When we started the business, it was pretty interesting. So going back to 1984, so it's like a history class now. But at the time, we sort of challenged the conventional wisdom, because anybody at that period of time has said, well, you can't lend to a startup company, you can't lend to a venture capital-backed company, because the venture capitalists, we all know, make 10 investments and they have one that's a home run, right? And so that's the venture capital model. Good for them, but obviously 9 out of 10 companies aren't viable credits. Well, actually, it turns out that that's really not exactly the case. That was the conventional wisdom. That's why no lender in their right mind would ever lend to a venture capital-backed startup. But we did some research, and we went back to Boston and met with Venture Economics, that even in 1984, they had a database of venture investment and results for the prior decade. And what we found out was that, well, that's right, 1 or 2 companies out of 10 were very successful. And we found that maybe 1.5 companies out of 10 actually went out of business. And that the other companies in the middle were companies where the VC would get maybe a 2x or a 1x or a 0x or a 0.5x or something like that. But they were most of those companies were the living dead. So there were 6 out of 10 companies that actually were going to survive longer than the term of a venture loan. So those people would pay back, if you lent to them, would pay back the loan at the high interest rate. So minimally, you'd have that. And then if you created a portfolio of venture capital-backed companies, you would stumble upon the 1 or 2 that were the home runs. And in fact, that's exactly the way the market worked out. But at the time, it was radical, and we had to challenge the conventional wisdom. So when we, in 1984, when we set out to find institutional investors to support this brilliant idea that we had, I'll never forget this because it was so expensive. We sent out 93 Federal Express packages, which was like a killer at the time. And we got this is over a couple of months, trying to find an institutional investor, and we got 92 no's and 1 yes. So we had one investment banking house in New York that had the vision to see that, oh, hey, this can really work. And it provided some ancillary opportunities for them. So they became our institutional partner. They had the bucks, and that launched the business. But when we do credit analysis, the evolution of all this is that we're looking for the survivors. And in that pack of survivors, there are going to be some really successful companies. But that's not our job to find the really successful companies. That's the venture capitalist's job. That's how he makes a living. We made a living by just finding the survivors. And in that group will be some winners. But that's okay if the rest of them aren't. So when we get to the credit criteria that we use,
I just switched to it because we're talking about it.
Thank you. All right, we like to say that we're looking for the survivors. So we look at what are the indicia for survival. That's what we would look for. So one of the most critical variables in survival is how much cash can you raise over how long a period of time, and how much patience does your venture investor have. So we really looked at, who are the investors? What are the venture capital firms? What's their MO? How do they behave in backing their companies? And so that does, in the more current environment, raise a really interesting point. In the old days, angels weren't so prevalent. Now, angels are everywhere. So the nature of the angel investor does matter to the venture lender. If it's somebody who's doing this as a hobby, that's not such a good thing. If it's one of these very serious, very experienced angels, well, that's about as good as a venture capital, institutional venture capital firm. So we look at what, in terms of the survival, we look at what is the exit opportunity for this particular company. And we look at it in sort of multiple contexts. Well, what if it meets all of its milestones and meets its business plan? Well, that's easy. It's going to be very successful. But then we sort of model it back down. Well, what if they don't quite get to their price point? What if the market shifts? What if the technology only does half of what it's supposed to? What if competition rears up? Prices drop? Who knows what? So how weak can this company be and still have enough value to repay the loan? And so that's a survival analysis that we would do. So, in that we're going to look at all of those variables. We're going to look at competition, market pricing, risk of technology development, and all of these things. We're trying to figure out how long can this company survive, and if it's not going to survive on its own, what is its liquidation value going to be? Then we drill down on that and we go, okay, well, liquidation value in a fire sale or liquidation value in an orderly sale of the company. The two create very different results. So anyway, that's, for those of you who are with the startup company, that's what you're going to want to be able to convince a venture lender of, that you're going to be able to survive even if you don't hit a home run. And then you'll get the debt money. Then when you go talk to the venture investor, you tell a whole different story.
So how much did it matter to you who the investors were in particular firms, particular partners at firms?
Well, that's interesting. Firms at one point in time had pretty homogeneous cultures. And with the bubble burst in 2000 and it became dog eat dog, that changed. So I guess I would say that the simplest answer is the culture of the firm does tend to dominate, but within each firm, there are investors that are known to be much more hardcore than other investors, much more willing to cut the cord, much less generous with their portfolio companies regarding missed milestones and that sort of thing. So the actual investor within the firm would matter some, but I would say the firm matters more than the individual partner.
You guys at Silicon Valley Bank have quite a database of that type of thing, don't you?
Yeah, I mean, excuse me. We follow it extremely closely in terms of the individuals within the firm and know sort of by individual what their characteristics or what their tendencies are. So I think, it depends too if we're looking at the very early stage, which, venture risk deals versus the business risk deals where it's a little bit less dependent on the investor, but we have a lot of information available. We bank 60% of the venture firms too.
Right. What do you do about angels and super angels? How are you thinking about that?
The dynamics are changing, so we have pretty close relationships with a lot of them as well. Obviously, they're sort of one-man shop in some cases, so it's all about that individual.
Yeah.
So I've got to tell a great story about picking survivors. It's, when was it, I can't remember, 98 or something like that, maybe 99, and my partner who did all the marketing, Lee Meier of Meier Mitchell, comes in and says, "Hey, I've got a $10 million deal," which is a big deal at the time, for this really hot new startup. It's another search engine, and so if you had to be in the time, because at that time there was a search engine, they were like gas stations. There was one on every corner. So there was Lycos, InfoSeek, AltaVista, Excite, Ask Jeeves, Dogpile, WebCrawler, and I could list 10 others. So what was totally in vogue was to do a search engine. So I said, well, if you can tell me what's special about this search engine, I'll talk to you. Otherwise, go do something else. So yeah, you guessed it, it was Google. So I turned them down because how could they be a survivor in a market that was already grossly overpopulated? And even at that time, the search engines were going out of business just because there was too much competition. So, damn. So the criteria is not always perfect.
Right, and it turned out they were financing they're building white boxes for the servers, and that's where that money was going to go. I did those white box financings later from someone else.
Yeah, from someone else, yeah.
And it was funny because the thing is you have to suspend disbelief, because I thought that was the coolest search engine out there, but I had no idea how they'd ever make any money. So.
Oh, that's right. Yeah, no revenue model. Well, actually, there's a happy ending to the story, because it was just a couple years later we had another deal with Google, but at that point, Google ascended very rapidly to dominate the market. So they were still private, and we went in to do a deal, and they were so arrogant at the time, they said, well, we'll do this venture loan with you, but no warrants. Well, forget about it. Remember I said the warrants were really critical to the venture lender? Well, I mean, you're Google, but I don't care. If there's no warrants, I'm out of here. So they called us back and said, okay, we'll do the deal with warrants. I couldn't believe it. Well, okay. So, gee, that worked out pretty well. So we actually got to do a deal with Google. But I will tell you, the valuation had changed.
Right.
Yeah. So it was a little, just a little bit different. So, yeah, actually, we went down there and sat down with Eric Schmidt and spent the morning, and he went through the numbers, and we were just shaking our heads. Why are you guys borrowing money at all?
Right.
Because at that point, the cash cow had started, and it was astonishing.
Right.
And this
yeah,
was,
that second round, they were already about 200 million of revenue or something like that.
Yeah, yeah, I think they were making 20 million a month, and
Yeah.
and they're still private. And sheesh, I did due diligence to figure out in the second deal if they're going to be a survivor or not, even though they were making money. And so my daughter was a freshman at UC Berkeley at the time, and so I called her up and I said, "Do you use a search engine?" She said, "Well, what's that?" And I said, "Well, how do you find information on the internet?" She goes, "Oh, we Google it." Okay, so you're already a verb. Deal was approved right there.
So that's a good transition. Just talk about equity component, how important that is to venture lenders and so on.
Yeah, the equity component is, I mean, it depends on the venture lender, I suppose. There are some who have tried to make a go of it with just money over money deals. In other words, no equity kicker. But for the pricing and the amount of risk that the majority of the venture lenders are taking, they need the warrant. It's a fundamental component of their business model. It's the way they pencil it out. It's that component that allows them to endure the defaults that they're inevitably going to have. And the thing that I really stress on this, without that warrant participation, you might actually be able to pencil this out and make a business out of it, and it wouldn't be a very exciting business. But that warrant, it makes enough of a difference that the venture lending firms are able to go out and raise institutional capital from investors, from the pension funds and other institutional investors that are looking to invest in the alternative asset class, which does require a higher rate of return. So to keep the spigot turned on, to keep the cash flowing appropriately into the industry, that warrant is a fundamentally necessary component. So you will see the venture lenders negotiate very diligently over the warrant coverage that they're able to obtain. And as we talked about earlier, there's a lot of things in the warrant document that are very important to them also.
So there's, and then there's the flip side of the business model. There was a venture lender called Comdisco and in the late 90s, they founded, what was it, an ISP or something like that? Yeah, it was an ISP, and were just, and pumped huge amounts of money into it. And they also had the venture lending business. And they were getting warrants, and they were getting big hits off these warrants in 98, 99. And they were using this money to fund their ISP, which was losing tons of money. And there was a point where they had flipped their model over because they were losing so much money that they had to get cash. They only wanted warrants. And so what we were doing, they would do these loans, and they didn't care what the terms of the loans are. All they wanted was the warrants. And so there was like a 6-month period where you just dictate what they wanted. You could just say, no, we're going to have a 1% interest rate. They didn't care as long as they got the warrants. they went under very quickly
Yeah,
after that.
yeah. I remember distinctly competing against them during that period. And no matter what you put on the table, their marketing guys would say, give me the last look, and they'd
Right.
fax in a bid that would just undercut you every time.
Yeah, you used to push back a little bit on the term sheets and so on, and you just pretty soon noticed that when you pushed back, there was zero resistance, and so you kept pushing back more. So,
Yeah.
but yeah, that's a great example of
They
the
were-
market distorting.
Yeah, yeah. They were too good to be true.
Right.
Yeah.
Right.
They really injured the market because Moody's did about as good a job understanding their business model as they did the all the real estate backed mortgage bonds. Moody's was very fond of them, and then they had a spectacular blow up.
Right.
And so Moody's then became very difficult and onerous with all the other firms that were in the venture leasing business,
Right.
which included us.
Right. Well, and in fact, that was a great example of GATX had a lot of problems too, just because they owned you at that point.
Yes,
Yeah.
it was.
So-
Yeah.
Yeah, and I should also point out that in terms of good market timing, Jim sold Meier Mitchell Company to GATX in 1999, which was a brilliant business move.
It looked a little frothy, so seemed like a good exit point.
Right. How about rights to invest in subsequent rounds? How do you think about that? How important is that? Because that, some venture lenders do it, some don't.
Yeah, I think it's a superb provision. You've already become familiar with the company. You've become an ally with the company. Theoretically, you're rowing in the same direction. So it's terrific to have that ability to invest in a subsequent round. And some venture lenders that are just debt-only people don't have the ability to invest equity capital because that has a whole different profile. So they have to have usually another internal source of money that they could invest in equity. But we used to love to have that provision because with really successful companies, it wasn't a question of whether they could raise money. It was a question of who they would raise it from. And if you had this right to invest, you could gain admission into a round with one of the star companies, down in the valley or wherever it was. And so it was a valuable provision. Now, I will say this, interestingly, we used it a lot in the late 90s when things were sizzling. And we had the right to invest in future rounds, in 2000, 2001, 2002. Well, the valuations had cratered by then, thanks to the bubble bursting. And so actually in that particular time period, a lot of those provisions had very little value. But I know that there are venture lenders out there today that utilize this provision in the current environment and find it to be very valuable. Yeah,
and a lot of this for companies just depends on what the capital needs of the company are. I mean, there are companies where it's, the more the better, and they're going to have high capital needs, and they're going to, if someone wants the right to invest, have at. The opposite, which is often true now, is that companies don't have tremendously high capital needs, and that's really the one where these rights can be something that crowd out investors that a company might want to bring in. So those can often be highly negotiated and contentious about getting that.
Are those rights typically to maintain your percentage, like Perry Pursue, or are they a certain amount, or
Both. Yeah. It can be, it depends. I mean, that's, maintain the percentage is one way it happens. Sometimes it's, up to $500,000. It's all over the place. Sometimes it's just the next round. Sometimes it's the, all subsequent rounds. So.
It's a much less standard provision, so it's really quite negotiable uniquely on each deal.
Right. And it's usually negotiable to the point that, lenders are usually not going to insist on it, A lot of times it gets cut back to, if everybody's happy, we'll give you an opportunity. It is the ultimate kicker in these deals. The warrants are kickers, but they are a necessary component. The right to invest with most lenders is not absolutely necessary.
It's not part of the business model.
Right.
It's really an upside opportunity.
Right.
Or a downside opportunity. It depends on how it works out.
Right. Right. Yeah. So this is. Do you have a question?
Yeah, just trying to ask, how often do the borrowers shop around?
Yeah, generally they shop a bunch. The most common is the borrower will go out and the borrowers are actually sort of new to the venture lending market, but their venture capital investors are very experienced with other companies in their portfolio that have done venture lending. So they get guidance from their venture investors, and the venture investor will say, go out and get 3 or 4 different quotes. And they'll bring it back, and usually it's such a standard component of the capital structure of a startup company now that the VC are very familiar with it, and they pretty much know what they want the company to obtain. But they will go out and get competitive quotes. There are some exceptions to that. There's a few very tight relationships where certain venture partners will say, look, just go to so-and-so and just do that. Or the other thing, you've got a relationship with Silicon Valley Bank, just get a loan from Silicon Valley Bank because they dominate the market and they'll be fair. But the norm is go get some competitive bids. So it is shopped.
Yeah, it just depends, as Jim was saying, on the company. I mean, I represent lenders about 30% of the time and companies about 70% of the time, and they come and they give me the term sheets and I help them go through them and so on. And the most companies get more than one term sheet. Not always, because there's some where they just go to one, and sometimes they've done deals with them at other companies before, and that's where they're going. Yeah, and then maybe a few companies get more than 5 term sheets, which at some point these are diminishing returns on people's time.
Waste of time.
But yeah, usually there's some competition. I mean, one of the things to talk about here too is the types of lenders too. Is that what Jim was alluding to is that startup companies that are doing deals that are smaller than $5 million are pretty much going to the banks now. We were talking to Mike Meier earlier, and just that the market used to be that the non-bank lenders were in there, and the banks have sort of moved into that space and are pretty much dominating it now. So, and on top of that, Silicon Valley Bank dominates that market share, and so in the smaller loans, fewer term sheets. Just because there's fewer players and they're largely banks. Some exceptions to that, but that's largely the case.
So who are the players in the market, Andy?
Well, so I mean, as we said, there's a number of bank lenders. There's Silicon Valley Bank. There's Comerica. There's Square One. There's Bridge Bank are the most likely players. The other banks outside of that pretty much still adhere to the principle that you really can't loan money to startup companies, and even though it's been proven otherwise. So that is largely who's out there. With the non-bank lenders, it's a pretty fluid market right now. There's a handful of players that have been around a long time. Western Technology's been there for a long time, and they've been around. They were around in the 80s, weren't they?
Yes, we were actually raising capital at the same time.
Right.
In fact, so they were around in the early 80s, and we were raising institutional capital, and they were doing a limited partnership with doctors and dentists. And we raised capital a little quicker than they did, but they showed up. It took them about 2 years to raise the money. They had the same problem we did. The conventional wisdom was this was foolish.
Right. Yeah. On top of that, there's Triple Point. Which is actually people that came out of ComDisco. It wasn't their fault that ComDisco blew up.
Yeah.
Pinnacle Ventures, Silver Lake has a unit called Silver Lake Waterman that's putting money in, which is and they're mostly doing interest-only loans. They're payable after 3 or 4 years.
Much later stage.
Much later stage. And that's generally true, is that the later stage is dominated by, the non-bank lenders are doing much more later stage deals. They're doing a lot more subordinated deals. Although some of the banks are playing in those areas too. Silicon Valley Bank has a mezzanine fund that that does subordinated lending into the later stage deals too.
Did you mention Hercules and Horizon?
Hercules and their Horizon. There's a number of newer lenders. One called Fifth Street. There's which people that came out of Oryx, which was a lender for many years. There's one called Structural Capital that started up recently. Usually, what happens is there are people that come from other lenders. But there's been a lot of ferment as different companies have exited. Some have had trouble raising money. There was a long period, after 2001 where the general venture capital returns weren't that good. Venture lending follows venture capital, so if there's venture capital investment, venture lending goes up too. So but there was a long drought there. So. Any others that I'm missing?
No, I think you kind of covered the waterfront. It's not a large population. It is very specialized. The names and faces tend to be the same. Sometimes they just shift companies. That's true in any specialized industry. So I think you've covered it. It's still a boutique, but the dollar amount of capital now, because of the size of the deals that's going into venture loans, is a very large number. Yes? Well, the loans aren't, they're not marketable, so you're stuck with them. So the answer to the question is that it's a very sophisticated market as it relates to entering into restructures. And unfortunately, there's a fair amount of experience in working with companies that have gone bankrupt or that are being liquidated. But I think the answer to your question is that the workouts are very sophisticated and very thoughtfully executed.
But for instance, if you're thinking about like the term loan B market, where if big $500 million, billion-dollar deals that are going south, those are traded in a market, and so once they start trading below par, sometimes they'll start spiraling down. There'll be bottom fishers that come in and buy something at 40 cents on the dollar. That doesn't happen so much here. It's too much friction, too fragmented. There aren't. The information is too hard to get about these companies. So anybody that is looking at them, can only see a mess. There's not a lot of times. There's not a huge amount of enterprise value that's always going to be there that will come through a bankruptcy, that type of thing. I think the outcomes are too binary on these things.
A large company that was once creditworthy has pockets of value even in a distressed situation. Typically, a venture-backed startup doesn't have any remaining pockets of value. That certainly not traditional.
It only has one pocket, and that one's bad.
Yeah, and it's been shown that pocket isn't working. So. Right. You're toast. So there's really no trading in these things. There's no place to hide. You just have to work it out.
Right. But that said, that sort of goes into our next slide, which we're talking about workouts, is that you do have these situations a lot where whatever it is in the company is not working right, and it becomes they're the ones that just crash, and those are pretty binary about what's going to happen there. The interesting ones are the ones that, it's going okay, it's going sideways. The company can probably raise another round, but they need a lot of help. And so a typical scenario is that, the company's still, they're past an interest-only period. They're probably amortizing down, and they have 6 months worth of cash left, and they're talking about a new round. Sometimes there's politics on the board. Sometimes the VCs don't have dry powder anymore, or some do, some don't. Some want to sell the company. Some want to put more money in. Have I got all the scenarios in?
Yeah, I think you've covered it.
And they come back to the venture lenders, and sometimes looking for a solution.
Well, the venture lender is brought to the table because they usually call the lender and say, you know what? we only have 6 months of cash left, so we're not going to pay you. So, okay. So why don't we sit down and have a meeting? And that's sort of how it starts.
You mentioned earlier that it's not, that the loan isn't collateralized by the IP. But I don't know if that was all the time or some of the time. And then in this case of whether it's tradable or not, do you have loans that are actually collateralized by IP? And have there been cases where someone has come in and said, hey, I would actually like to buy that loan that's collateralized by the IP, even though that no one's different things going on there, but I would actually like to buy that loan. Does that occur?
Well, two questions. The first question is like how many are collateralized by IP? I don't have a specific number. I'd say 40% are collateralized by all assets and 60% don't have IP. I don't know, Mike, does that sound right?
So like 20%.
20%? Yeah.
At least at the outset.
Yeah, yeah, and that's another point is that very often when you're doing a workout, the IP, the first time you do the workout, when they need something that you're doing an amendment or something like that, you get the IP as collateral. So.
But there was a second part to your question, and I've never seen anybody come in to buy the loan as sort of access to get to the IP because the loan contains the security interest to the IP. Never seen that.
Right. I mean, one of the things when people talk to me about, I mean, there's a lot of sensitivity about having a lien on IP. And when I talk to people about it, I say, look, I don't see it as that big a deal. It is, I mean, IP is an asset like any other asset. And I always view it as a tool. And if it can get you the deal you need to get in a loan, and you give up a lien on the IP, it doesn't bother me that much. It's a gut feeling that people have that they don't want it, but I have not seen, having done this in many, many years, it mattering that much to a company as to what the outcome is whether there's a lien there or not. Usually, if the company is very, very distressed and can't pay its loans back, IP is not worth very much.
That's the company usually is its IP. That's larger companies, Apple and Samsung are arguing about IP, but that's just an entirely different ballgame because they have a very diversified portfolio of IP.
Yeah. And just to talk about what from the legal side, what having the IP or not having the IP is, people think that if you have a lien on the IP, the lender can just, if there's a default, can just take the IP and go home. And it's not how it works. There's there's essentially the UCC provides that you have to do a commercially reasonable foreclosure sale of the IP. So if the IP is worth $100 million, you have to sell it for $100 million, and then you pay off the lender, and then the equity gets the rest. Reality is that it's never worth $100 million, right, at that point where you're foreclosing. So, but you can't just take it. I mean, very often the lender will end up with the IP because the lender can credit bid. So they can take what they're owed and they can bid in the foreclosure sale with that debt. And so often the lender is the most likely one to end up with it, and then we'll sell it off because in almost all cases they have no interest in actually exploiting the IP. So. What else? The other thing, just talking about participation in restructurings, the big thing that happens in these restructures that we're talking about is that often they'll try and get the venture lender to solve all the problems, and that's a conversation that usually happens. And what the venture lenders usually want is participation by the equity. They're not going to. It's very unusual for them to just convert to equity or do something like that, because if they did that very often, you would end up with washed out all the time.
Quickest way to zero is to convert to equity.
Right. So how do those conversations go with the equity when they just want you to convert to?
It's a sort of a mutual assured destruction. If we foreclose on the collateral and liquidate it, the company's out of business. So we have a lever. If the venture investors don't put up some more money, we're going to foreclose. So we've got a lever that induces them to put up money. But then they say, well, if we put up money, we don't want it to just go to pay you back. We want it to go into the company so the company has a chance, a second bite of the apple here. So it's a negotiation bred from fear and relative weakness. Who's weaker than the other party? So it really depends at the end of the day on whether the venture guys think that if you can stop the payment on the debt, do a moratorium on debt, so you free up that cash, provide a little more cash, does that equation create an opportunity for the company to recover and regain its footing? And if they think that that'll work, they'll put in more money, has been my experience. And if they're not very confident that's going to work, they'll just throw up their arms and say, go get your collateral. That's it. Usually there's an emotional attachment to the company that's stronger than the financial attachment. Nobody likes to admit defeat. So, it's fairly likely that there'll be some pocket of cash that'll come up to give a company at least one restructuring, if there's any glimmer of hope. But oftentimes they'll give them a small amount of cash, and again, my experience is that gets them farther down the runway, but it's not enough, and then people aren't willing to put more cash in, and it craters. But it's a dynamic tension between the parties.
Do you ever find you're in a position where you actually can bring in a new investor group, on a proactive basis to
No.
do that?
No, it sounds like you might be able to do that, but usually the situation's so complex, that would be like a total restart. And so the new investor group wouldn't even want to come in with the debt overhang there. They'd pick up the pieces and just do a restart and wash out everybody that was in there, including the lender.
Have you funded restarts where you take your debt and roll it into a restart?
Yes, there have been a few of those. It's not real common, but definitely happens.
How about communication during these workout periods?
Daily, hourly.
Right.
Yeah, it's usually really intense. Again, because we monitor companies literally monthly, we pretty much know. With venture capital-backed companies, because of their regular burn, their predictable burn rates, and the amount of cash they have, you can pretty much look and find out what month on the calendar they're going to be in trouble if they don't raise more capital. So the communication starts well in advance of the company falling off the cash cliff. And the parties usually get together to negotiate a resolution of the problem before the brick wall's been hit. So the communication, in my experience, has been very good amongst the parties. I mean, it gets really acrimonious, but there's a lot of talk. Yes?
In those restart scenarios, is it typically the existing insider equity investors that are sort of leading that, or is it a third party?
It's a third party. I don't think I've ever seen the same investor come back and do a restart. I'm sure it's happened, but not to my experience.
Dilutive, down around
Well, actually, they usually do a clean start. It's not even a down round, because you just want to get rid of all the liabilities, all the baggage.
Right.
So usually just
sell it to a new entity.
You see, right? You'll sell the IP. That's probably all there is, or maybe assign the real estate lease to a new entity, and you just move forward from there.
It does happen where you have a dysfunctional investor group, where sometimes you'll have one investor that will do the restart. It's legally a complete mess when that happens, because if that restart works, then all the other investors think they were cheated, and it doesn't end well.
Yeah. You need to get rid of the liabilities, wipe the slate clean, start over, and that's what a restart should be. We've got just a couple minutes left before the hard stop. So, any final questions?
When you're looking at a borrower, and they come to you, is there a single factor that would lead you to say yes or no, whether to do the deal or not, or what would be the most important criteria for you?
Well, there's no single factor. It's just that bundle of sticks that creates, is this a survivable entity? Will they survive long enough to pay us back? Or do they have enough critical mass or enough value in what they have or where they're going and how they're backed to survive long enough to generate enough cash over time to pay us back? And that's usually not any one variable. It's really simple. If they have $20 million of cash in the bank and they're burning, you know, $100,000 a month. Well, okay, we can do that. But it's usually a very subjective analysis.
But a theme to it often, I think, is like, you know, how predictable is this company going to be going forward? You know, and there's a lot of factors that go into that. And, you know, it's one of the things about, you know, Jim was talking about the war story about the evil genius. You know, if you have a company like that and you can see that coming, that's, you know, it's not predictable what's going to happen. That is one where venture lenders will shy away from it. And that's one reason why traditionally you've had professional investors involved, because the professional investors either can control that,
yes,
or they will just shy away from it in the first place, and that's a sign that you don't want to lend to it too. So, but that's part of it is, you know, are they going to behave in a way that, you know, is rational going forward? Because there's a lot of good outcomes, and you know, sort of aberrant behavior can blow things up when there's still value there.
And Andy made a good point that the business is really built upon the predictable behavior of the borrowers, and that's really dictated by the quality of the venture capital guidance that they get. Those VCs sit on the board, they hire the management, they dictate the budget, and you assume a company is going to be well run if it's venture, you know, professionally, institutionally venture capital backed. That's an underlying assumption. That's why venture loans aren't just for startups; they're for venture capital backed startups.
Although, you know, there's a tranche of loans that get done outside of that now, just because that's, you know, that's where the money is.
Yeah.
So.
Anything else?
Could you comment a little bit more about that, about venture loans for non-venture backed firms?
Yeah, I mean, so criteria, I'm not sure what the criteria are. I mean, a lot of times it's kind of the same thing in that it's a recognized angel or someone like that. And so it's just a substitute for the professional investor. It is sometimes it's an entrepreneur that's been down the road 4 times before and they just know them really well. But, you know, and I think it becomes very subjective to particular lenders. Mike, do you have criteria for that type of thing? Because you guys do a little of it.
The non-sponsored deals,
yeah,
they typically have to be of a decent scale from revenue, so you know, 10 to 15 million at least. And to the extent that they are bootstrapped at that point, they're probably showing some profitability. So it's not sort of early venture debt, it's more that growth gap kind of, or AR lending at that point. But yeah, to the point in terms of management team being a key, you know, valuation criteria and scale.
So we've hit 9 o'clock, which is when we'll release everybody. So thank you all very much. I think Jim and I can stick around for a few
hang
minutes.
around, sure, if you want to
talk.
Yeah, if you have further questions. Thank you.